Adi, really, really horrible day in the market. Nasdaq down 4%. What the hell is happening to the market?
You know, it's interesting because you told me let's do a video why the market is crashing, and a lot of people are saying, hey, what's happening in the market? Why is the market crashing? And you know, you can put a lot of narratives on it. But you know, Andrew and I, we did a little bit of a digging and we found some interesting stuff. What the hell's happening, Andrew?
So today was the job market, and the job market, it seems that unemployment went down, which is really good for economy. There's a 3.5%. Economists were expecting 3.7%. And that caused the market to drop significantly. I had some person emailing me and said, hey, how is it possible? Because job market is strong, that's good for the economy, means it's good for the company. Why the market is selling off like 4%? The answer to that goes to two things. The number one, Adi, is that the Federal Reserve, the US central banking system, they are raising the interest rate to bring down the inflation. And the only way that they stop doing that is to hurt the economy so bad that the fear of deflation actually goes up. So the prices, instead of going up, prices going down. So a strong stock market, a strong job market means that Feds should be more hawkish or more aggressive to increasing the interest rates, because then people are still have money, there are more jobs and spending, and the inflation doesn't cool down. They want to cool down the inflation.
Yeah. So it's kind of a double-edged sword, right? The bad news is good news in a sense, because the job market is strong. That means people have more money, they can spend more. When they can spend more, inflation won't come down. But there's another side to that story, and if people have jobs, they can spend, so that means earnings are gonna be strong. So earnings won't be as bad. So, I mean, it is one of the reasons we say it's a very challenging market. It is very challenging in a sense where, you know, Fed's going to be more aggressive, so interest rates are going to go higher. When interest rate goes higher, that's cost of capital. When you discount that cash flow back, you know, that's going to be smaller. So, you know, the market has to adjust and has to come down. But on the other side, if job market is staying strong, that means people will spend money on the new iPhone. People will buy the stuff from Amazon. Companies will spend money on advertising on Google. So that means earnings should held up nicely. So, you know, we are getting into the earnings season over the next week. Banks are going to start with the earnings season. You know, if earnings stay up pretty good and held up pretty good, we might hover around this 350. I mean, who knows, right? But it is a possibility.
But fundamentally, when the job markets are strong, I read this article in Bloomberg today that the article was the labor market is coming for profit margins, or worse, that was the title. So it means that the companies may be still hiring, but they're actually getting hit in their profit margins. Like, for example, you and I have businesses and we are still hiring, but that hiring comes at the expense of the profit margin of the business.
Because the sales are not growing, right? Sales are not growing as fast, and you know, if you think your labor is a percentage of your revenue, right, you have to spend more on your labor as opposed to your revenue. Basically, your labor cost is growing faster than your revenue is growing, so that pushes down your margins. It is one of the things. It is definitely putting an impact on the market. But I mean, as you've said it very famously in the chat room, the message is very clear. They want inflation down. For inflation to come down, there's a really interesting chart that we will show you that shows never in a history inflation has come down meaningfully without a recession. So Fed's gonna induce a recession. A recession is definitely gonna happen. It's just we don't know how severe it is going to be.
Yeah, in the 1970s, that chart is actually from the Federal Reserve website, I think.
Yeah, it's from the Fed website.
Inflation in the 1970s was about 6%, and it took them almost 2 years to bring them down with a recession in between. And then there was another one that in 1974, that the inflation was above 10%, and they had to take the economy into a recession to bring down the inflation back to 5%, ran up again in 1980s to 10%, 12%, and then it took them 2 recessions to bring down into 2%. So that this year, like 10 months, we're 10 months into the year, and this was the worst beginning so far since the 1930s. The market is down over 25%, Nasdaq down almost 40%, 35%.
So worst beginning since the 1930s for the 60-40 portfolio. So if you had 60% stocks, 40% bonds, basically the worst year ever, because bonds have sold off tremendously as well because the rates have gone up. And for the stock, worst year since 1970s. So historic measures. You said it very nicely. You said they're gonna write books about 2022.
Yeah, I mean, we are just frog in the pot that we don't understand that we might really be in the midst of a very big financial phenomena that we don't understand that. So 60-40 is a typical portfolio balance that they say 60% stocks, 40% bonds. That's a very typical hedge funds and portfolio managers standard that if you were going to have 60-40, you would have been really, really bad this year. You were down at least 26%, 27%.
That's a lot, by the way. If you're right around retirement and your account value goes down by 30%, that's gonna put a huge dent into your lifestyle and into your retirement. So that's major, right? That's when we talk about tightening financial conditions. That's one of the things. But Andrew, I want to switch gear a little bit, and I want to talk about TINA, right? The fact that there is no alternative. And I was looking at my trading account, brokerage account, and I've been about 35% cash, and I was looking at it, analyzing my return, and I saw I got this massive interest payment from Interactive Brokers. And it is one of those areas, if people are asking us, hey, what should we do? It's one of those areas where if you're a trader, trade the market. If you're not a trader, if you're an investor, you're getting paid to wait. Put your money in cash. IB right now is paying, Interactive Brokers right now is paying around 4% interest on your money in your idle cash. So sit on cash, wait another 3 months, wait another 6 months, see what happens. Is inflation coming down? Is earning holding up nice? It's okay if you don't pick the right bottom. It is okay. And wait a few months, and while you're waiting, you get paid 4%. That's pretty hefty. That's a good deal. And if you're a trader, if you're a day trader, experienced swing trader, trade the market, right?
Yeah, that's the whole point. When the risk-free rate is 4 or 5%, I know some GIC, a government-issued certificate deposits that they're 5%. Why would you risk your money in the stock market, which is inherently more risky, therefore you expect more return? So when it's 5%, people are cashing out, putting the money in the safe haven, and that's why the market is dropping. It's just not enough buyers. The drop of the market, it means that there are more sellers than buyers. It's not that there is no buyer, but there's just the number of the buyers are less because people are not interested to put their money. And they can do this until the Federal Reserve reaches to a point that, okay, not everyone can put their money and get 5%. You have to boost the economy, and then they have to bring down the interest rates to encourage people to go and spend and invest and produce, so to expand the economy. But at this stage, it means that we haven't seen the bottom yet. So now the question is, are they doing it too fast? Shouldn't they wait for 3 months with this 4%, 5% and see maybe with the supply chain and the energy and the war in Russia, maybe it settled down a little bit?
Yeah, no, that's a great question. It is one of the fastest rating cycles we've ever seen. We're going to put a chart in there that shows actually the speed of the rate increase. It's one of the fastest we've seen. But Andrew, did you know there's actually a formula for what the rates should be? It's called the Taylor rule formula, right? So it's based on actual inflation versus inflation expectation, as well as actual GDP output versus the long-term GDP output. So you can actually calculate what they call it the neutral rate, like what the neutral rate is going to be. And I was actually over the weekend, I was playing with the numbers, what the inflation expectation is, what is the GDP output. We're getting really close to the neutral rates, so I don't think they can continue this aggressive rate hike. Right around 4.5% is your neutral rate. They have to stay at a neutral rate for about 6 months, 7 months, 8 months, and then see how the market is going to react, right?
Yeah, that's so we have probably a 0.75 increase in November, and then they're going to have another one in December, and then to wait and see what's going to happen. Yeah. So the 10-year Treasury is right now is at 3.8%. Yeah. So means that the Feds doesn't control the 10-year, do they? No. That the market.
Well, that's usually the market, unless they're doing some kind of a yield control. You know, that's when they go and buy the bonds in the long end of the treasury yield. But they're not doing that right now, right? When they do yield control, they do control the yield curve, but they're not doing that right now.
So it means that the market believes that 10 years from now, it's probably going to be 3.8, 3.5%. Yeah. So they're not going to be over 4. Yeah. What about the short term, like 2 year? What's the 2 year treasury right now?
Usually they say the best indicator, it has like a 95% accuracy indication of where the Fed's funds is going to go, is the 2 year. You need to take a look at the 2 year. I believe 2 year is at around 4.2, 4.3%. I didn't check this morning, but yesterday it was around 4.2%.
So in 2 years it's going to be 4.
So basically it's a really good indication of where the rate cycle is going to end. Right, so 2 year, that's basically it. Another way to look at it is what the Fed's fund rate is going to be 2 years from now, which is the 4.2%.
So there won't be any easing in that case. If the market by 2 year treasury they're saying 4.2, 2 years from now, and it's 90% accurate, so 2 years from now the rates is still 4%.
Yeah, basically they're probably going to keep the rates at around there. But again, remember the 2 year can also change, right? So as the new information comes in, if all of a sudden labor market is collapsing, then you will see the 2 year come down tremendously. That would be a great trading opportunity, by the way, buying some 2 years, because the price of the 2 year is going to go up and the yields are going to come down. So.
Yeah, 100%. All right, thank you so much. So what do you think, guys? I mean, the people in Twitter, today was a really, really like Black Friday. We just wanted to have this video. Let us know what you think, when you think the market is bottoming, and if you like this video or not, we're going to make more of these videos for you.
Yeah, make sure to subscribe to our channel. We look at the number of subscribers exactly the same way we look at our portfolios. We obsess over it. So, you know, give us a subscribe if you enjoy our content, obviously, and we'll see you again, and tell us if you like this format. We can do more of these.
Yeah, awesome. Thank you so much, guys. Cheers.